Yes, thank you once again for tuning in, friends. I'm your host, none other than Mr. Spotter Fred. Now, we'll continue doing what we have been doing, and that's what I normally say. We'll continue doing what we like doing most. Remember, what we have been doing from the previous sessions is the tuition for advanced financial reporting. We have been looking at the topic 3. We have been looking at topic 3 in respect to assets and liabilities. Assets and liabilities. We have done a good number of items, and now it is becoming interesting as time goes by, So we have this. We have talked about assets held for sale, assets held for sale. Assets held for sale is under IFRS number 5. We have also looked at the impairment of assets. Friends, this was IAS 36. Then we also looked at the exploration, and evaluation of mineral resources. This was IS, not IS. It's now under the IFRS family or IFRS 6. Then we also have what we refer to, apart from exploration and evaluation of mineral resources, we have talked about financial instruments. And on financial instrument, it was IS 32, IS 39, IFRS 7 and 9. So we have looked at that. Then we also have share-based payments. That is IFRS 2. Then we also looked at in employment benefits. Employment benefits, IS 19. We also, now this one we have not done it. This is accounting for taxes. Accounting for taxes, IS 12. Friends, you have noticed that in the previous sessions, we did this, and we also looked at this. We have also looked at this. We have looked at this one. We have looked at this. We have also looked at the most recent session. We must have looked at IS 19. Now we have not looked at the IS 12, accounting for taxes. And that's what we want to do today. So accounting for taxes. Accounting for taxes. Accounting for taxes, that is IS 12. Now, when you talk of taxes, we are simply referring to the amount out of the profits, that you should remit to the tax authorities, to the government of a country, right? So, like for example, if you say in Kenya, the tax rate is at 30%, the corporate tax rate is 30%, right? So those are the amounts out of the total profit you have made. There is a tax element that you need to remit to the government for operations, because the main source of revenue for government entities or activities is taxes. Fine. So we have accounting for taxes, IS 12. Now, we are very much concerned, let me just say that tax, that is an amount of profits, remitted to government authorities, for operations, for financing the activities. We are concerned, accounting for taxes, we are not concerned with the amount they recognize to or to be remitted to the tax authorities. But we are so much concerned with how do we account for tax in the books of accounts. So when we talk of tax, we are concerned of the current. We have the current stroke the income tax, the income tax. Then we also concerned with the deferred tax. We are concerned with the deferred taxes. Those are the main two items we'll be concerned. How do we account for current or income tax? How do we account for deferred taxes? That's what we're concerned with. Now, friends, one thing you also need to remember, when it comes to current tax, it's almost straightforward. So when we talk of current tax, current taxes. Current taxes, or we can call it corporation tax. Corporation tax or current tax is not something that should worry us so much because it's so straightforward. The amount of taxes, how to account for this. So determine the corporation tax, the corporation tax, which is actually the current tax, the corporation tax for the year. That is, we simply, the current tax or the corporation tax, the current tax is simply, you take the tax rate, you have the tax rate, you multiply the taxable profits. I'll also remind you something that you must have done in the tax concepts in our video. In our video for taxation, you have done the tax concepts. So you know that we talk of taxable profits. When we talk of taxable profits, this is simply the accounting profits. This is the accounting profits before tax. Accounting profit before tax. You add back the disallowables, then you subtract the allowables. Remember, the disallowables are those expenses you have recognized in your financial statements for the purpose of determining the accounting profit. But for income tax department, DTA, Department of Tax Authorities, they are not allowed. They're not allowed to be adjusted against profits. So you add back, those are profits, you add back, but those are allowables, mainly the capital allowances. So an example of disallowables is like depreciation. We have depreciation, let me say, disallowables are e.g. depreciation expense, general provisions, items like donations to non-charitable organizations, what else? And other disallowable expenses. We also have the allowables. Allowables include capital allowance. Capital allowance can also be called, wear and tear allowances. So, and etc. and any other allowable expenses. So that's how we get the taxable profits. Then, after you have got the taxable profits, now you compute your current tax. After you have determined the current tax, friends, now account for it now. So, thus, after determining current tax for the year, you need to debit the profit or loss account as an expense, that is an expense. Then you credit current tax account. current tax account. The current tax account. So that is the tax expense, the corporation tax for the year. With the amount paid, with the amount paid, with the amount paid, with the amount paid, with the amount paid for taxes, with the amount paid for taxes, we debit our current tax, we debit our current tax account. With the amount paid, we credit our bank, we credit our bank account. That is important. Now, one thing you also need to remember, at some point you may be required to have a current tax account. To have a current tax account like this. If it's a liability, you recognize that at the beginning there is an amount which had not been paid. Then the expense for the year, the amount we have taken, the expense, yeah, as the amount we have taken, that we have calculated by taking the tax rate by the taxable profits. Then you amount which has been paid, no, bank, this is the payments. The payments, we come and now recognize that. Then we will have the balances carried down. These are the figures which will be reported in the statement of financial position. The balance carried down will be reported as a current liability, while the amount reported in the profit or loss is reported as an expense. So just a summary of how to deal with the current tax. We don't have so much problem when it comes to the current tax. Now remember, friends, we have just summarized how to deal with the current tax. The other most important item that comes in again here is about the over or under provision of tax, under provision of tax in prior years. If there is an over provision or if there is an under provision, then it means that in the previous year you recognize you estimated more tax or you estimated less tax. So if you over provided for tax in the previous year, then this year it will be reported as a credit, as an income. So an over provided tax in prior year will be recognized as an income in the current year to reduce the effects of the tax expense of the year. That's what you do. That is an over provision. The same thing with an under provision. An under provision will be considered to be an income. An under provision will be considered to be an expense. The under provision will be an expense. In the year. So it will increase our current tax expense for the current year. So those are some of the items that you may have when we are dealing with taxes. That's very important. Now we'll want to move further and look and talk about deferred tax and talk about accounting for deferred tax. Accounting for deferred tax. Accounting for deferred tax. Accounting for deferred tax. Still, we are under IAS number 12. Still, we are under IAS 12. Don't forget that. This is IAS 12. Even this one was IAS 12. Don't forget, we are still under IAS 12. So, when you talk of deferred tax, this amount, deferred tax is the amount of tax that you enjoy in the current year, of which tax should be paid or should be received in the future period. So when we talk about deferred tax, we are taking advantages in the current times, but the tax of which will be either paid or received in future. It will end up to be a tax credit or a tax debit in future. That's the deferred tax. Now, how do we determine the deferred tax? This deferred tax may either be, we may have a deferred tax income, we're interested to have the deferred tax. There is a deferred tax income, and we may have a deferred tax expense. We also have the deferred tax asset, and we have the deferred tax liability. You need to also remember, I've said that the deferred tax income or expense is the income that we have earned in the current period, but we are likely to receive or we are likely to pay or not even in future. Then the deferred tax asset or liability, the deferred tax asset is the amount of tax that will be receivable in the future period, while the deferred tax liability is the amount of tax payable in the future period. That's important to note that. Deferred tax asset, I can remind you this, the deferred tax asset is the amount of taxes receivable in the future, while the deferred tax liability is the amount of taxes payable in the future. We'll have to define some other items later in details, but for now we have to talk about a few items here, like the deferred tax asset and deferred tax liability. How do we determine the deferred tax asset or liability? If we are to compute the deferred tax asset will take into account the tax rate you multiply by deductible temporary differences. And how do we compute the deferred tax liability? Our deferred tax liability is also equal to the tax rate. We take the tax rate, you multiply the taxable temporary differences. So we have this deferred tax asset and deferred tax liability, and that's what you should remember. Now the issue as well here is, how do we compute the temporary differences? What are these temporary differences? We are going to define them. What are these temporary differences? How do we compute temporary differences? So temporary differences, which I'm going to have as TD, will be equal to the carrying amount of assets, stock liabilities, which I'm going to have as CA, minus the tax basis of assets, stock liabilities, what I refer to TB. So TD is the temporary differences, and CA is the carrying amount, and TB is please remember, TB is not tuberculosis. For this case, TB is the tax base of an asset or liability. Very important, so that you don't confuse that. So at any point in time I'm talking about TB, you know that I'm talking about the tax base. So you come and say, this can be done this way, that if you take the carrying amount minus the tax base, that's the TB, you will get the TD. This TD will either be taxable, or will either be deductible, And taxable TD, taxable and deductible TD, so this will give rise to deferred tax liability. These will give rise to deferred tax liability, while these will give rise to deferred tax asset. That's important. Now, we'll want to give some definitions. Some definitions are so obvious. So we'll want to still look at them once more. What are these differences? Now, the differences between accounting profits and taxable profits are either permanent differences or temporary differences. Permanent differences, they do not reverse in any period, as therefore they do not give rise to deferred tax. E.g., some items may be used in accounting profit, yet they are not reflected for tax. 2, there is a temporary differences. These reverse in future, therefore resulting into deferred tax. Methods of accounting for taxes may be either of actual taxes payable method or deferred tax accounting methods, and as a result, these will give rise to the temporary differences. And you should now remember that temporary differences is simply the difference between the carrying amount of assets and liabilities and the carrying amount on the tax base of assets and liabilities. The temporary differences may either be taxable or deductible. The temporary differences may either be taxable or deductible. Now, when we talk of taxable temporary differences, these are differences that will result in taxable amounts in the future when the carrying amount of the assets are recovered or the liabilities are settled. They give rise to deferred tax liability balances at the year end. Deferred tax liabilities are amounts of income taxes payable in future periods in respect of taxable temporary differences. So the taxable temporary differences will arise when the carrying amount of assets exceed their tax basis or the carrying amount of liabilities are less than their tax basis. The deductible temporary differences will give rise, will result in deductible amounts in the future when the carrying amounts of the assets, when the carrying amounts of assets or carrying amounts of liabilities are recovered, or when the amount of assets are recognized. They give rise to deferred tax assets balances at the year end. Now remember that our deductible temporary differences will arise when the carrying amounts of liabilities exceed their tax base and when the carrying amounts of assets are less than their tax basis. That is important to remember. Now, what I've simply said is this. I've said when you talk of the temporary differences, is simply the differences between the carrying amount and the tax basis that will give rise to deferred tax assets. So we have temporary differences being the differences between, in summary, between the carrying amount and tax basis Yeah, we have already said that the taxable temporary difference will give rise to deferred tax liability, while the deductible temporary difference will give rise to the deferred tax asset. You need to also remember about the carrying amount. The carrying amount of an asset or liability is the book value. This is the historical depreciable costs. Depreciable costs in case of an asset. In case of an asset, in other words, we are saying is the net book value. The revalued amount of an asset. We have book value of book value. I can also say net realizable value of an asset or liability. That is simple what we should know about the carrying amount. How about the tax base? What is the tax base? Tax base, friends, is the amount of tax. This is the amount of an asset, or liability attributable for tax purposes. So attributable for tax purposes, that's important. And we may have a few problems with the tax base, but you should remember this. You should remember how to determine the tax base. How do we determine the tax base of an asset? Determination of tax base of an asset. There are four main items that we need to look at. However, the rest will be the same. There are four main items. There are 4 or 5 main items. So one, let me say the item here. I say the tax base. There are 4 or 5 main items that we'll identify. Otherwise, any other asset, the carrying amount will be the same as the book value. So very important there that we have, like, number 1, there are those depreciable assets, subject to capital allowances. If this asset is depreciable and it is given a capital allowance or wear and tear, then the tax base will be the written down value. Now, friends, written down value is not the same as the net book value. Written down value is the cost minus accumulated tax depreciation. Accumulated tax depreciation is not accumulated depreciation. Accumulated tax depreciation is simply accumulated capital allowances. Then we come and say another item is the revalued assets. Revalued assets without depreciation, that they are not depreciated. Then the tax base will be the cost, while the carrying amount is the revalued amount. Don't forget that. Then we come on to 3. 3, we may have some assets. As a result of which has been adjusted by general provision. So assets, especially the current assets, subject to general provisions. A provision, all provisions will be general unless you're told that is allowable for tax purposes. If it's allowable for tax purposes, then we say it's a specific provision. So current assets subject to general provisions. Then the tax base will be the gross amount. For this case, you don't forget that the carrying amount is normally equal to the net realizable value. Net realizable value is simply the the cost minus the general provision. The gross amount now will going to be the net realizable value. You add back the general provision. You add back the general provision. That will be the gross amount. Then another item we also need to take into consideration when you are determining the tax base, we are going to have current assets, current assets, current assets, current assets as a result of accrued income, accrued income, not taxable, no, accrued income recognized for tax on receipt, So this accrued income, we are not going to recognize it for tax purposes until we receive it. If you find that statement that we are only going to recognize it for tax when we receive it, then it means you're trying to defer your taxes. So what will be the tax base? The tax base now is nil. So we'll not have a tax base on that item now. We'll not have a tax base on that item now, but we'll recognize it for tax purposes in future, so we'll be deferring our taxes. Number five, we may also have current liabilities as a result of accrued expenses recognized for tax purposes on settlement. On settlement, if we are going to only recognize this liability when we pay in future, then it means the tax base now is nil. The tax base now is nil. That's important. Those are the main items, but there are also other items like sometimes intangible assets. Remember, if intangible assets are recognized for tax purposes fully, but you amortize part of the intangible assets during the year, then you should remember that the part you have not amortized in the year will have a nil tax base. That's very important. So other than those intangible assets, these items are the main items. Any other asset or liability that we have not mentioned here, then it means the carrying amount and the tax base are the same. It means the tax base and the carrying amount are the same. This is a very important summary. It's a very important summary that can really take us a long way. Now, I'll give us more example just to identify the taxable and the deductible. A small example, just a small example, a small example. A small example, just an example, a small example where we have consider the following balances and determine the temporal differences, thus identify whether they are taxable or deductible. So we have the item, we have the carrying amount, we have the tax base, and we want to identify now this what we want to do. We want to identify whether it is, we identify the TD. Then we also identify whether it's taxable temporal difference or deductible temporal difference. Want to determine that. So the asset, let me say, this is asset what? Asset A, B, C. I can also call it, I have liability X, Y, and Z. So we are going to have figures here. Let me start with maybe a simple figure, 200,000. Then the tax base maybe is 180,000. Then we talk about asset B. We have something to do with 300,000. Then we have the tax base here coming to 400,000. Then we have asset C. Maybe we can talk about we have 500,000. Then I put the 500,000. It's good to use big figures, It's good to always get used to these big figures. Then we come to liability X. Liability X, let me use a bigger figure, A big figure is better. You get used to these big figures because very, very soon you'll be holding these figures. You'll be having these like pocket change, Then 800,000, let me now use the other one to be something to do with the 620,000. I'm just using guesswork here, friends. Then we also have, let me talk about maybe 2.5 million. Yeah, it's good to use a big figure. 2.5 million. Then the other one, let me have it as 3.6 million. 3.6 million. That's interesting. Then we also have something to do with the Z. Z, can we have it as 4 million? 4 million. Then 4 million as well. Now, what will be our temporal differences? For asset A, the temporal difference will be 20,000 because we are simply taking the carrying amount minus the tax base. Then asset B will be 300,000 by minus 400. That is going to give us 100,000. Now that sounds to be a negative. Then the other one will be nil. It will be 0. Then the other one will be is going to be, I'll have to take a calculator with this one now, is coming to 800 minus 620. I'm getting 180. So 180,000. Yeah. Then the other one is 2.5 minus the 3.6. We are getting 1.1. 1.1. Now this is negative. Yeah. Then this will be 0. Now, is it taxable or deductible? The amount we had as an asset A is 200,000, the carrying amount, but we have only recognized 180 for tax purposes. So there is an excess of 20,000, which will give rise to deferred tax, which will give rise to more economic benefits in future, and that it will give rise to taxable temporal difference, and that will be a deferred tax liability. So we are going to have it taxable temporal difference. Then the asset B, we have a carrying amount of 300,000, but we have recognized more for tax purposes, which will give rise to less taxes in the future, less economic benefits in future, less taxes in future. So this is the deductible temporal differences. And this is nil, there is nothing there. Then we have 800, this one 180, because it's a liability, is going to give rise to more losses in future, and that means it will give us a deductible temporal difference. With this one, it will be deductible temporal difference, while our liability Y is 1100 negative, so that is going to give us more economic benefits in future, thus giving rise to more taxes in future, and that will give us to the taxable temporal differences. So these will be dashed, there will be nothing. So that was just an example to warm us up in respect to identification of the temporal difference and how to identify whether it's taxable or deductible. That's interesting. Now, friends, we also need to look at revaluation. When an asset has been revalued and there is a revaluation surplus, there will always be tax element on the revaluation surplus, because it will be assumed that this asset is likely to be sold in future. And that revaluation surplus should also be adjusted to reflect the tax component. So revaluation of assets. When an asset has been revalued, we normally debit our asset account, we credit our revaluation surplus or our revaluation reserve account. So it should be remembered, in a case of a revaluation surplus, there is a tax element. There is a tax component on the revaluation surplus. So remember to adjust. Remember to adjust. Remember to adjust. Revaluation surplus. Revaluation, let me say, not revaluation. Tax effect. Tax effect on revaluation surplus. Tax effect on revaluation surplus. Thus, deferred tax on revaluation will be on revaluation surplus will be, you take the tax rate, you multiply by the revaluation surplus. Then after you have done that, now you should be able to debit your revaluation reserve account. Then you credit deferred tax account. After we have talked about that now, I want to give you a summary of what you should do in determination of deferred tax income or deferred tax expense. So determination of deferred tax income, expense, asset, stroke liability. What are the steps? Step number 1, identify the tax base, the carrying amounts, tax bases, and temporary differences. You identify that. Then step number 2. Step number 2, compute the deferred tax asset stroke liabilities. You know, it can be an asset depending from which direction you are looking at it. Because if you have a taxable temporal difference, then you'll have a deferred tax liability. If you have a deductible temporal difference, then you'll have a deferred tax asset. Then we move on to step number 3. So compute the deferred tax. I mean, this is simply, we are saying you take the tax rate, you multiply the temporary difference. That temporal difference may either be taxable or deductible. So step number 3, I determine tax on revaluation surplus, if any. Revaluation surplus, if any. Determine tax on revaluation surplus, if any. Then step number 4. So in step number 4, we need now to open a deferred tax account and determine the deferred tax income or expense as a balancing figure. So determine the deferred tax income or expense as a balancing figure in the deferred tax account, that's what you should do. I can demonstrate opening the deferred tax account. We can demonstrate how that deferred tax account will be like. We can demonstrate how that deferred tax account will be like. How the deferred tax account will be like. So deferred tax account, we have the balances. If it's a liability, it can be a liability or it can be an asset. We may have an asset. We may have a deferred tax asset. This is the asset. Then the balances we have computed. This is the asset, the figure we have computed, or it can be a liability. The one we have just computed, these balance carried down are the ones we have computed. Then we have the tax on revaluation. The tax on revaluation surplus. Then the balancing figure, it can either be here, this is an expense, or it can be an income. Let me call it deferred tax income. So you may have either an income or you cannot have two balancing figures is one of them. Now this is just a summary of what we should do. However, you should also remember we have account methods used to provide for deferred tax. The methods used to provide for deferred tax. One, we have the nil provision basis. Nil provision basis is also referred to as the nil provision basis, and is also referred to as flow through method. Then we also have the full provision basis. Then we also have partial provision basis. This is the most preferred by the standard. Nil provision basis, you don't recognize deferred tax. You only recognize current tax. But full provision basis, you recognize your deferred tax on all temporal differences. Partial provision basis, you only recognize deferred tax to the extent that you are going to recover the taxable temporal differences. But now the most recommended is the full provision basis. We also have some methods of accounting for deferred tax. Methods, we have two of them, deferred method, and we also have liability method. But the liability method is the recommended. Deferred method was dealt away with in the old standard, and now in the revised standard we only use liability method, where we carry forward liability, especially where there is changes in tax rates. Now, these are some of the summary that we have discussed in respect to accounting for taxes. Our next level now is to carry out or to do an example that will really portray what we should do in respect to deferred tax. Now we look at a question in June 2010, question 2C. Is a question that was done in June 2010, question 2C. So I'll create some space here. I'll create some space. To do June 2010, question 2C. Jazz Group is estimating the deferred tax liability as of 31st May 2010 and has provided the following information. 1. Property, plant and equipment as a cost and revalued amount of 100 million and accumulated depreciation of 18 million. Total capital allowances on property, plant and equipment amounted to 30 million. 2. The group has available for sale financial assets that were purchased during the year at a cost of 10 million. There was a revaluation gain of 2 million reported in the available for sale reserve. 3. The group spent 50 million shillings to develop a new product, and out of which 10 million has been charged in the income statement as amortization for the year. The balance of 40 million is shown as intangible assets in the statement of financial position. The full amount of 50 million was allowed for tax purposes in the year. 4. Total inventory was carried at 20 million, which was the net realizable value. The cost of the inventory was 22 million. There was an unrealized profit of 1 million that had not been deducted from the inventory on consolidation. 5. The receivables amounted to 30 million after making a provision of 2 million for a doubtful debt. The amount also included a foreign exchange gain of 1 million shillings. Exchange gains or losses and doubtful debts are only allowed for tax purposes when they are realized. 6. The trade and other payables of 40 million include an accrual of 5 million, which relates to pension and other employee benefits to be paid in the year 2011. These are only allowed for tax purposes when paid. 7. The deferred tax liability as at 1st June 2009 was 8.5 million. 8. Assume that the temporary differences due to the revaluation of property, plant and equipment amount to 2 million shillings and the corporation tax rate is 30%. Required. Compute the deferred tax balance as of 31st May 2010 and the charge to the income statement for the year ended at 1st May 2010. Now, from the required point of view, we need to compute the deferred tax balance as of 31st May 2010. So we need to get either a deferred tax asset or a deferred tax liability and the charge to the income statement. So we need to use, when I say the deferred tax balance, we are looking at step number 2. If you look at the deferred tax charge, we are looking at step number 4. That's what we are simply saying. Fine. Now I'll go back. You realize that our financial year ends on the 1st May 2010. Let's start off from the beginning. One of the steps is to identify the carrying amounts, the tax base, and the temporal differences. I can even do that as a working. Can do that and say maybe we are looking at step number 1. Step number 1, we want to determine the carrying amount, the tax basis, and the temporal differences. And the temporal differences, I can come and say item, I'll recognize the carrying amount, I recognize the tax base, and I recognize the TD, and then maybe identify whether it's a TTD or a DTD, whether it's a taxable or deductible temporal differences. Just from the first note number 1, property, plant, and equipment, it means that the first item is the property, plant, and equipment as a cost and revalued amount of 100 million and accumulated depreciation of 18 million. So if you have the cost and revalued of 100 million, accumulated depreciation of 18 million, then our carrying amount is simply the net book value, which will be 100 minus 18, and that is 80 what? 100 minus 18 is 82. Our figures are in millions. Our figures are in millions. Our figures are in millions. So millions. So we have 82. 82 is the net book value, is the carrying amount. We have simply taken the costs. We have subtracted the accumulated depreciation. That's our carrying amount, or rather the net book value. Then we have been told total capital allowances on property, plant and equipment amount to 30 million. So it's subject to depreciation and capital allowance. If we didn't have capital allowance, then the carrying amount could be the same as the tax base. But now we have the capital allowances. So what will be the tax base? The written down value. You remember the summary that we must have done some time back? Yes. So that's what we are referring to. We are referring to determination of the tax base. So with this one, because there is depreciation and capital allowance, then our tax base will be the written down value. We take the cost of 100, we subtract the accumulated capital allowances of 30 million. So that is 70. So what is the temporal difference? The temporal difference will be 12. And you realize that our carrying amount is in excess of the tax base by 12 million, then definitely that's the taxable temporal difference. We move on to number 2. Item number 2. The group has available for sale financial assets. So this is available for sale assets. The available for sale assets, we have been given, number 2, that were purchased during the year at a cost of 10 million. There was a revaluation gain of 2 million reported in the available for sale reserve. Now, when we are recognizing such an asset, if it does not have depreciation and it cannot, this is a financial instrument, then it means that our carrying amount will be the revalued amount, the fair value. If it was not been, it was never revalued to their fair values, we could have recognized the carrying amount as the cost. So it was revalued, and the carrying amount would definitely be 12. That is the figure to be reported in the statement of financial position. That's the book value. That's the carrying amount. But what will be the cost? What will be the tax base? The tax base is definitely the cost. That means that we are trying to expose the 2 million, which was a revaluation surplus, to be a temporal difference. So this definitely is also a taxable temporal difference. Item number 3. The group spent 50 million shillings to develop a new product, and out of which 10 million has been charged in the income statement as amortization for the year. The balance of 40 million is shown as an intangible asset in the statement of financial position. The full amount of 50 million was allowed for tax purposes in the year. First and foremost, there is research, that is research and development. That number 3. We are talking about research and development, that the group spent 50 million to develop a new product, out of which 10 million has been charged in the income statement as amortization. The balance of 40 million is shown as an intangible asset. So 50 minus 10 is the 40. So 40 is the carrying amount. And we have been told that out of the total amount should have been recognized for as a tax allowable, meaning we could have not identified only 10. We could have identified the 50 million as an amortization. But now we have only, out of the 50, we have only recognized the 10. So the remaining 40 will be recognized for tax purposes in future. It means out of the 40, the tax base now is nil. So we have 0, so this will be 40, and definitely taxable temporal difference. Number 4, total inventory was carried. So we are talking about number 4 is inventory. Number 4 is inventory. They are saying total inventory was carried at 20 million, which was the net realizable value. The cost of the inventory was 22 million. Fine. Before I go further, 20 million is the net realizable value. So 20 million is the carrying amount. Carrying amount is the book value, net realizable value. We are talking about the revalued amount. So in this case, the net realizable value is 20 million. And the cost of the inventory was 22 million. It means it was 22, but they recognized 20, the lower of, according to IS number 2. So there's a 2 million which must have been a provision. There was an unrealized profit of 1 million that had not been deducted from the inventory on consolidation. So before we go to the provision, we know that we had 22, we recognized 20. So at that point, the tax base will be 22. We add back the provision of 2 so that we make it 22. But out of the 22, there is a profit which had not been realized. There is a profit, unrealized profit of 1 million that had not been deducted. Because it had not been deducted, it is going to be adjusted accordingly. There is no, unrealized profit is simply a provision. It's simply a general provision. Because it has not been deducted, so we add back to get the gross, so it will be 23, and this is 3. Now that makes it to be deductible temporal difference. Don't forget that. Number 5, the receivables. Now number 5 is a receivable. The receivables, number 5 is a receivable. The receivables amounted to 30 million. So let me recognize the carrying amount as 30 million. After making a provision of 2 million, so I add back the 2 million, so that would be 32. Then for a doubtful debt, the amount also included a foreign exchange gain of 1 million. So it included. These exchange gain or losses and doubtful debts are only allowed for tax purposes when they are realized. So before they are realized, we should exclude it. It's not going to be recognized for tax purposes. That means we are going to have 30 plus 2 minus 1. So we are going to have 31. So that we have 1 here. And in that case, this one is deductible temporal differences. That's important. Let me show this by a sign of that way. Then number 6, the trade. So this is trade and other payables. That is trade and other payables. We have the trade and other payables of 40 million. Yeah, they have said is 40 million. That's the carrying amount. Include an accrual of 5 million, which relates to pension and other employee benefits to be paid in the year 2011. And remember, we are in 2010. So these 5 million, we have been told, these are only allowed for tax purposes when paid, will be recognized for tax purposes on settlement. So now, out of the 40 million, there is a 5 million. Now, number 6, the trade and other payables of 40 million shillings. Now, remember, they are talking about the trade and other payables. Over how much? Of 40 million. Let's continue. Include an accrual of 5 million, which relates to pension and other employee benefits to be paid in the year 2011. Remember, we are not in 2011. We are in 2010. These are only allowed for tax purposes when paid. So that out of the 40 million, there is a 5 million that will be recognized for tax purposes when it will be paid, that is in future. It means out of the 40 million, there is a 5 million whose tax base will be nil. That means that out of the total 40 million, we have 5 million that will not be recognized for tax purposes now. And what will be recognized for tax purposes now differently will be 35. So we have 35 million, and that means the temporal difference is 5 million. Being a payable, being a liability. Friends, remember, these have been assets. These are assets. We only have one liability and the payable. You notice that the carrying amount of 40 million is greater than the tax base. If it was an asset, it could be a taxable temporal difference. But this one is a liability, so it is a deductible temporal difference. Very important there to note, is easy to confuse. Don't forget that. So remember that this is a liability, trade and other payables, unlike these ones which are assets. These are assets. These are assets, unlike trade and other payables, which is a liability. So what will be the total? So I take the 12 plus 2 plus 40 minus 4 minus 5. I'm getting 45. 45 million. So what will be our deferred tax liability? Because I've noticed that the deductible are less. Let me call it here net. We call it net taxable temporal difference. So the taxables are more than the deductible. So that's a net taxable temporal difference of 45. Now we can come and compute the deferred tax. We compute the deferred tax liability because I didn't see anything. Number 7 and 8 is something else, is not going to contribute this. So our deferred tax liability, which will be the tax rate, you multiply the taxable temporal difference. And in that case, we had 30% of 45 million. How much will that be? So I take my calculator, I say by 30%, that is 13.5 million. In note number 7, we were told about that the deferred tax liability as at 1st June 29 was 8.5 million. That's the deferred tax balance brought down. 8, assume that the temporary difference due to the revaluation of property, plant, and equipment was 2 million and the corporation tax rate is 30%. So we have already used it. Now, we need to open, so we have got this figure that we were required to do, that's the liability. So we open our deferred tax account, so that we determine the deferred tax expense or income. We have been given the balance brought down. Our figures are in millions. We have been given an 8.5. And we have also computed the balance carried down as 13.5. That's the one we have computed as 13.5. Then we have been told there is a revaluation surplus. So tax on revaluation surplus. There is a revaluation surplus there are 2 of them. There is available for sale, that is note 2. Note 2, available for sale, that will be 30% of 2 million. And that is 0.6. Yeah. Then we also have PP, that is note number 8. Note number 8. Coincidence, it was also 2%, so 2 million. So 30% of 2 million, how much would that be? Let me try to separate this like this. So that comes to 0.6 as well. So how much would be our deferred tax? It can be profit or loss. This is the balancing figure. It could be a deferred tax. It was a deferred tax income. But from what I'm seeing, it's definitely on the other side. So it is the figure will be definitely here. That is the balancing figure. So we have deferred tax expense. Deferred tax expense, how much would that be? 13.5. So this should be 13.5. So it's 13.5 minus the 8.5 minus the 1.2, and that is the 3.8. So we have the deferred tax expense of 3.8 and a deferred tax liability of 13.5. This 13.5 will be reported as an incurred liability, while this 3.8 will be recognized as an expense in the profit or loss account. So I know you have enjoyed, and we have done something that is worth viewing. I know you have enjoyed. Thank you very much. Have a nice time. Enjoy your revision. Until next time, when we'll be looking at other topics in other videos.